Something shifted in the UK housing market this week, and if you are not paying attention right now, at the very end of May 2026, you are going to miss a moment that does not come around often. Because the data that has landed in the last few weeks is not telling one story, it is telling three stories simultaneously. And depending on who you are, a first-time buyer, an existing investor, someone sitting on a property they are thinking about selling, each of those stories means something completely different for the decision you need to make in the next 60 to 90 days. So that is exactly what we are doing today. We are breaking down the UK housing market at the end of May 2026. What the latest property price data is actually telling us. Where the market is moving faster than people realize. Where it is still soft, and why. And the expert insight that turns all of this information into something you can actually act on. This is not a highlights reel. This is a proper, thorough, honest, end-of-month property breakdown. Welcome to Nespath UK, the channel that takes the UK property market seriously and gives you analysis that respects your intelligence and your time. If you are new here, hit subscribe right now, because we do this every single month, and this channel is becoming one of the most trusted voices on UK property for a reason. Let us get straight into it, because there is a lot to cover, and every minute of this video matters. Let me start with the number that everyone wants to talk about first: house prices. What has actually happened to UK residential property values as we close out May 2026? And more importantly, what does the headline number hide that you absolutely need to know? The national average UK house price figure, as reported by the major indices this month, is showing something that the market has been quietly building toward for the better part of 6 months. We are in positive territory on an annual basis. Year on year, the average UK house price is up. Not dramatically. Not the double-digit annual growth that characterized the pandemic boom years, but positive, sustained, and, critically, broadening. Meaning that it is not just one or two regions pulling the national average up. It is becoming more widespread. Now here is the thing about national averages that Nespath UK has been saying for years, and that I want to repeat again today, because it genuinely cannot be said enough. The national average UK house price is one of the least useful single numbers in property analysis. It tells you that something is happening. It does not tell you where it is happening, why it is happening, or whether it is relevant to the specific market you are buying or selling in. And right now, at the end of May 2026, the gap between the best performing and worst performing segments of the UK market is so wide that the national average is actively misleading if you try to apply it directly to your own situation. So let us get specific. Let us go region by region and segment by segment, because that is where the real story is. The Northwest is one of the standout performers in the UK property market as we close May 2026. Manchester and its surrounding areas, Salford, Stockport, Trafford, and the broader Greater Manchester conurbation are seeing transaction volumes that are comfortably ahead of where they were this time last year. The combination of relatively accessible entry prices compared to southern equivalents, strong rental demand driven by the city's enormous student population and its growing financial and digital services sectors, and continued infrastructure investment, the ongoing expansion of transport connectivity, the regeneration of former industrial areas into mixed-use neighborhoods, is creating a market where buyer confidence has returned with real conviction. What is particularly interesting in Manchester right now is the new build segment. Developers who paused or slowed projects during the period of peak mortgage rate pressure are releasing product back into the market, and they are finding buyers ready to engage. Purpose-built apartment developments in city centre and inner suburb locations are selling at a pace that tells you something important about where investor and owner-occupier confidence currently sits. If buyers were uncertain, those units would be sitting. They are not sitting. Liverpool is a similar story, and in some respects an even more compelling one from a pure value perspective. The price-to-rental income ratio in Liverpool remains one of the most attractive of any major UK city. Gross rental yields on well-located residential properties in Liverpool are running ahead of most other major UK centres. And the city's ongoing regeneration, waterfront development, the expansion of cultural and creative districts, improving transport infrastructure, is creating a credible capital growth case alongside the already strong income story. For investors who are still on the fence about the Northwest, the data coming out of Liverpool at the end of May 2026 is making that fence increasingly uncomfortable to sit on. Now let us move across to Yorkshire, because Leeds and Sheffield are both doing something interesting that deserves its own discussion. Leeds has become, in the view of many serious property analysts, one of the most balanced property markets in the UK right now. What I mean by balanced is this: the fundamentals of demand, supply, affordability, and income generation are all pointing in broadly positive directions simultaneously, without any one of them being stretched to a point that creates obvious risk. Leeds has a huge student population. It has a growing financial services sector. It has improving transport links. It has property prices that, while they have grown meaningfully over the past decade, have not reached the level where affordability becomes the dominant constraint on further growth. Sheffield sits at a slightly earlier stage of the same trajectory in some respects, with price points that are even more accessible relative to rental income potential in certain areas, making it particularly attractive for yield-focused investors. The university presence in Sheffield is substantial. 2 universities with a combined student population that runs into the tens of thousands. And the demand for quality student and young professional accommodation continues to underpin the rental market regardless of what the broader economy is doing. Here at Nestpath UK, Sheffield is a market we have been watching very closely, and the picture at the end of May 2026 continues to support the case that we have been making for it. Well-located houses in multiple occupation, properly managed, in postcodes with strong proximity to the universities and good transport access, are still delivering net yields that significantly outperform the UK national residential average. That is a meaningful statement, and it is backed by the numbers. Let us now talk about the South, and specifically about London, because London is doing something this month that requires careful interpretation, and that has real implications for investors and buyers across the entire UK market, not just those who operate within the M25. London's property market at the end of May 2026 is showing a split that has actually been developing for several months, but that is becoming sharper and more defined as we close out May. Prime central London, the areas that attract high net worth domestic buyers and international capital, is performing strongly. Demand from overseas buyers has been supported by a currency dynamic that makes sterling-denominated assets attractive to buyers from dollar-pegged Gulf economies, from Asian markets where local currencies have strengthened, and from European buyers for whom the post-Brexit discount on UK assets has not yet fully reversed. If you are looking at prime London as an investor, the picture is one of resilience and quiet strength. Transaction volumes are not spectacular, but the buyers who are active are serious, financially capable, and often paying in cash or with minimal leverage. That kind of buyer does not disappear when mortgage rates move. That kind of demand is a structural feature of prime London, not a cyclical one. But the story in outer London and the commuter zones around the capital is more complicated. Here, the affordability stretch of the past decade left prices at levels that required the lowest interest rates in history to sustain. As rates rose and then stayed elevated, buyer affordability in these zones took a meaningful hit. Transaction volumes fell. Some areas saw genuine price softening. And while the rate improvements of the past 12 months have brought some buyers back, the recovery in these zones is slower and more fragile than in the prime market or in the northern cities. For buyers considering the outer London and commuter zone market right now, the message from Nestpath UK is nuanced. There are individual opportunities where motivated sellers, longer time on market properties, and willingness to negotiate are creating genuine value entry points. But broad brush optimism about outer London as a category is not warranted by the current data. You need to be specific. You need to know the postcode. You need to understand the local supply and demand dynamics in the micro-market you are targeting not the macro-regional trend. Here is something I want to address directly right now, because I am seeing this question come up constantly in the comments and in conversations I have with viewers of this channel. People are asking, is this a good time to buy? Is it better to wait? Are prices going to keep rising? Or is there another correction coming? And I want to give you the most honest answer I can give, even though it is not the clean, simple answer that everyone wants. Here is the truth. Nobody, not me, not the major bank economists, not the most seasoned property professionals in the country, can tell you with certainty where UK house prices will be in 12 months. Anyone who tells you they know for certain is either mistaken or selling you something. What we can do is assess the current balance of pressures and form a reasoned view about the most likely direction of travel. And here is what that reasoned assessment looks like at the end of May 2026. The factors that are supporting prices are improving mortgage affordability as rates have come down from their peak, returning buyer confidence as the market has proven it found a floor and did not collapse, continued structural undersupply of housing in high-demand areas, strong rental demand, creating income support for investment properties, and positive signals from the government on planning reform that could eventually, over years, not months, improve supply. These are real factors. They are pushing in a supportive direction for property values. The factors that represent headwinds or risks are the cost of living pressure that continues to constrain the savings ability and deposit building capacity of many first-time buyers, the regulatory environment for landlords that is adding compliance costs and complexity, the fact that prices in some markets, particularly outer London and certain high-growth commuter zones, remain stretched relative to local incomes, and global economic uncertainty that could affect confidence and financing conditions if conditions deteriorate. On balance, the picture at the end of May 2026 is one where the supporting factors outweigh the headwinds in most markets, but not uniformly, not in every location, and not without risk. Which is why at NestPath UK we always come back to the same foundational principle. You do not invest in the UK housing market. You invest in a specific property, in a specific location, at a specific price, with a specific financing structure, aligned to a specific personal goal and time horizon. That specificity is everything. The national story is context. The local story is where the decision lives. Now let me give you something that I think is genuinely valuable and that most end-of-month property market content completely skips over. Let me talk about what the mortgage market is doing right now in detail, because the mortgage market in late May 2026 has some specific features that create both opportunity and risk for buyers who are not paying close attention. The competition among lenders for mortgage business has intensified meaningfully in recent weeks. Several major high street lenders have made rate reductions in May, and the specialist and challenger lenders who compete for buy-to-let and portfolio investor business have also been trimming their product rates. This competition is good for borrowers. It means that the rate you were quoted 6 weeks ago may no longer be the best available rate today. If you are in the process of buying, if you have a mortgage offer that is a couple of months old, it is absolutely worth having your broker do a fresh market check before you complete. You may find that a better product is available and that switching now, before completion, makes financial sense. For investors refinancing existing properties, this is equally relevant. The gap between where base rate tracker products are sitting and where a well-priced 5-year fixed rate product is has narrowed in a way that changes the calculus for many landlords. 2 years ago, fixing for 5 years felt expensive because the rate was high. Right now, locking in a 5-year fix at current levels, before any potential further movement in either direction, is an option that deserves serious consideration for investors who value payment certainty and who want to lock in the current margin between their mortgage cost and their rental income. One more thing on mortgages before we move on. The criteria around portfolio landlord lending, the specialist mortgage rules that apply to investors who own 4 or more mortgaged buy-to-let properties, has been evolving. Some lenders who had tightened their portfolio landlord criteria significantly during the rate pressure period are showing signs of loosening those criteria as the market stabilizes. For investors who have been held back from growing their portfolio by restrictive portfolio landlord criteria, this is worth a fresh conversation with a specialist buy-to-let mortgage broker in the next few weeks. The market is moving, and the best information is always the most current information. Let us talk now about the rental market at the end of May 2026, because for investors this is arguably the most important piece of the picture, and it is a market that continues to defy the expectations of people who have been predicting that rental growth would slow significantly. Rental growth across the UK has not slowed to the degree that many analysts expected at the start of 2026. Average rents across the country are continuing to rise on an annual basis, with some regional markets showing annual rental growth that remains comfortably in the mid to high single digits as a percentage. The driver is consistent, and it has not changed. There are significantly more people who need to rent than there are quality properties available for them to rent. That imbalance is the product of years of landlord exits from the market, constrained new supply, and growing demand from a population that includes millions of people for whom the deposit and affordability barrier to home ownership remains genuinely prohibitive. For existing landlords with well-located, well-managed properties, the rental market in late May 2026 is providing strong income support. Void periods, the gaps between tenancies that reduce annual income, are short in most active rental markets. Tenants who find a quality property at a fair price are increasingly motivated to stay for longer, driven partly by the difficulty of finding alternative accommodation if they move. Tenant retention is becoming one of the most valuable outcomes a landlord can achieve, and it is a product of the quality of the property and the professionalism of the management, which is exactly what NestPath UK has always advocated. For prospective investors looking at buying rental property in the current market, the income side of the equation is providing a level of support that reduces one of the core risks of entry: the risk that the property will not attract tenants quickly or that rent levels will disappoint relative to projections. In most active rental markets right now, well-priced, well-presented properties let quickly and at strong rents. That is a material risk reduction for investors who are evaluating whether the numbers work. Let me now give you the practical, actionable insight that I want every person watching this video to take away. Because information without action is just entertainment, and this channel exists to help you act better, not just to feel better informed. If you are a first-time buyer and you have been preparing, building your deposit, sorting your credit file, understanding your borrowing capacity, the end of May 2026 is a moment where the market is genuinely more accessible than it was 18 months ago, and where the competitive pressure for properties, while returning, has not yet reached the levels that will make buying feel frantic and stressful. Act in this window. Not recklessly, not without doing your homework on the specific property and location, but with intention and confidence. If you are a landlord with properties on variable rate mortgages, or with fixed rates expiring in the next 6 to 9 months, get a mortgage broker conversation booked right now. The rate environment is more favorable than it was. Locking in a competitive product now, rather than drifting onto a standard variable rate, or waiting and hoping rates fall further, is, for most people, the financially prudent choice. If you are an investor looking to add to your portfolio in the second half of 2026, the northern cities I have discussed today deserve serious attention. The fundamentals in Manchester, Liverpool, Leeds, and Sheffield are aligned. The entry prices are accessible relative to rental income potential. The long-term demand drivers are structural and sustained, and the window of time before these markets become significantly more competitive as more investors recognize what is happening may be shorter than you think. And if you are someone sitting on a property you have been thinking about selling, the returning buyer confidence and the slowly firming asking prices of the past few months suggest that 2026 is a better selling environment than 2023 or 2024 was. You are not at the peak of the market. I cannot tell you when that is or whether it is coming soon. But you are in a market where serious, financially capable buyers are active again. That is a better environment for selling than the one that existed 18 months ago. This is the end of May 2026. The UK housing market is moving. It is not moving uniformly, and it is not moving simply. But for people who understand what is driving it, where the genuine opportunities sit, and how to align those opportunities with their own specific circumstances and goals, this market has real potential to deliver. That is what NestPath UK exists to help you see. If this video gave you genuine value today, if you are leaving with something you did not have when you arrived, please hit the like button right now. It matters more than you might think for helping this channel grow and reach the people who need this information. Subscribe to NestPath UK if you are not already here. We do this every month, we go deep every time, and we are not going anywhere. And leave me a comment. Tell me what is your biggest question or challenge with the UK property market right now at the end of May 2026. Is it the mortgage environment, the rental regulations, where to invest, whether to buy or rent? Tell me specifically, and I will respond personally where I can. The market is moving. NestPath UK is watching it with you. See you in the next video.